Meet Sarah, a 28-year-old graphic designer living in New York City. For years, Sarah had heard about investing but always thought it was something only rich people did. She was scared of losing her hard-earned money and didn't know where to start. Sarah's savings were sitting in a low-interest bank account, and she felt stuck. One day, while having coffee with a friend, she learned that her friend had been investing for years and had seen her money grow significantly. This piqued Sarah's interest and made her realize that maybe she, too, could start investing. Did you know that nearly 50% of Americans don't invest in the stock market? This means many people are missing out on opportunities to grow their wealth. Investing can seem overwhelming and risky, especially if you don't know much about it. But with the right guidance and a bit of courage, anyone can start their investment journey. In this video, we will break down the basics of investing in simple terms. You'll learn what investing is, why it's important, and how you can start, even if you have just a small amount of money. Let's embark on this journey to financial growth together. Number 1. Understanding the basics. When Sarah first heard about investing, she felt lost. There were so many terms and options that it seemed confusing. Let's break it down simply. Investing means putting your money into something with the hope that it will grow over time. The most common investments are stocks. When you buy a stock, you own a small piece of a company. If the company does well, the value of your stock goes up. Bonds. Think of bonds as loans you give to a company or government. They pay you back with interest over time. Mutual funds. These are collections of stocks or bonds managed by professionals. They let you invest in many things at once. ETFs. Exchange-traded funds similar to mutual funds but traded like stocks on the stock market. Real estate. Buying property to rent out or sell later at a higher price. Investing is important because it helps your money grow faster than just saving it in a bank. Over many years, even small investments can grow into a significant amount. Understanding these basics helps you see that investing isn't just for the rich. It's for everyone, including beginners. Number 2. Overcoming the fear of investing. Sarah was scared of investing because she feared losing her money. This is a common fear for many beginners. Let's look at how she overcame this fear. One day, Sarah met with a financial advisor named Mike. Mike explained that it's normal to be afraid of investing, but there are ways to manage this fear. He said, "Think of investing like planting a tree. It takes time to grow, but with care, it can provide fruit for many years." Mike talked about risk and reward. He explained that all investments have some risk, but the potential rewards make it worthwhile. The key is to understand and manage the risks. Mike introduced Sarah to the idea of diversification. This means not putting all your money into one investment. Instead, spread it across different types of investments like stocks, bonds, and real estate. This way, if one investment doesn't do well, the others can still grow. He also emphasized the importance of a long-term perspective. Investing isn't about getting rich quick. It's about letting your money grow over time. Sarah felt more confident knowing that she didn't need to invest a lot of money right away and could start small. By learning about risk management, diversification, and thinking long-term, Sarah began to overcome her fear and took her first steps into the world of investing. Number 3. Setting investment goals. Sarah realized that before she could start investing, she needed to set clear goals. Setting goals helps you know why you're investing and keeps you focused. First, Sarah thought about what she wanted to achieve. Did she want to save for a house, plan for retirement, or build an emergency fund? She decided her main goal was to save for a comfortable retirement. Mike, the financial advisor, introduced Sarah to the SMART criteria for setting goals. SMART stands for specific, measurable, achievable, relevant, and time-bound. Specific. Be clear about what you want. Sarah's goal was to save $500,000 for retirement. Measurable. Know how to track your progress. Sarah decided to check her investment account every 6 months. Achievable. Set a realistic goal. Based on her income, Sarah figured out she could save $300 a month. Relevant. Make sure the goal matters to you. Retirement was important for Sarah's future security. Time-bound. Set a deadline. Sarah aimed to reach her goal in 30 years. By setting smart goals, Sarah had a clear plan and knew how much she needed to save and invest each month. This made her investment journey more organized and less overwhelming. With a solid goal in mind, she felt motivated to start investing and stay on track. Number 4. Building a beginner's investment portfolio. Sarah was excited to start investing but wasn't sure where to begin. Mike helped her build a simple investment portfolio suitable for beginners. First, they talked about choosing a brokerage. A brokerage is a company that helps you buy and sell investments. Sarah chose an online brokerage because it had low fees and was easy to use. Next, they discussed the types of investments Sarah should include in her portfolio. Index funds. These are funds that track a market index, like the S&P 500. They are less risky because they spread investments across many companies. Sarah liked the idea of steady growth with lower risk. Target date funds. These funds automatically adjust the mix of stocks and bonds as you get closer to your goal date, such as retirement. This was perfect for Sarah's retirement goal. Blue chip stocks. These are shares in large, well-established companies known for their stability. Sarah decided to invest a small amount here for potential growth. Mike advised Sarah to start small. She began by investing $100 a month, which fit her budget. They also talked about rebalancing her portfolio every year to make sure it stayed in line with her goals. With this simple plan, Sarah felt confident. She had a mix of investments that matched her risk level and goals, and she knew she could adjust it as she learned more. Starting small and staying consistent was her key to building a strong investment portfolio. Number 5. Continuous learning and adaptation. After Sarah made her first investments, she realized that learning about investing doesn't stop there. To be a successful investor, she needed to keep learning and adapt her strategy over time. Sarah started by reading books on investing. She found The Little Book of Common Sense Investing by John C. Bogle very helpful. It explained investing in simple terms and reinforced the importance of patience and long-term thinking. She also listened to podcasts like the Investing for Beginners podcast, which provided easy-to-understand tips and advice. These podcasts helped her stay updated on market trends and learn new strategies. Joining online communities and forums, like those on Reddit, gave Sarah a place to ask questions and learn from experienced investors. She found it comforting to know others were on the same journey and willing to share their knowledge. Mike advised Sarah to review her portfolio every 6 months. This helped her see how her investments were performing and decide if any changes were needed. For example, if a certain stock was not doing well, she could sell it and invest in something more promising. By continuously learning and adapting, Sarah felt more confident in her investing skills. She knew that by staying informed and flexible, she could better handle changes in the market and make smarter investment decisions. This ongoing education was key to her long-term success as an investor. Number 6. Common mistakes to avoid. As Sarah continued her investment journey, she learned that avoiding common mistakes is crucial for success. Here are some pitfalls she learned to steer clear of. Chasing hot stocks. At first, Sarah was tempted to invest in trendy stocks she heard about in the news. Mike warned her that these stocks are often risky and can lead to big losses. Instead, he advised sticking to stable, long-term investments. Not diversifying, putting all your money into one investment is risky. Sarah learned to spread her money across different types of investments, like stocks, bonds, and real estate. This way, if one investment does poorly, others can still do well. Ignoring fees. Sarah didn't realize that some investments come with high fees that can eat into her profits. She started paying attention to the fees charged by mutual funds and ETFs and chose low-cost options whenever possible. Timing the market, trying to predict when the market will go up or down is very hard. Sarah learned that it's better to invest consistently over time, rather than trying to buy low and sell high. Lack of emergency fund. Investing is important, but so is having an emergency fund. Sarah made sure to keep enough money in a savings account for unexpected expenses, so she wouldn't need to sell investments at a bad time. By being aware of these common mistakes and how to avoid them, Sarah felt more secure in her investment choices. She knew that careful planning and steady investing would help her reach her financial goals. Investing is not just for the wealthy, it's for anyone willing to take the first step. It's about planting seeds today for a better tomorrow. Now, if you want to learn how to achieve financial success, then watch this video next. And if you made it to this point of the video, please like and subscribe to the channel to see more content like this. Thanks for watching, and I'll see you in the next video.